Welcome to the Tech Guys Who Invest podcast, where each week you will learn how to invest wisely and safely. On this show, you'll hear about lessons Adam and Kevin are learning on their investor journey, as well as insights from industry experts. Our vision is to educate, entertain, and bring tons of value to you. Welcome to our show.
Welcome, everybody, to another episode of the Tech Guys Who Invest podcast, where each week you learn how to invest wisely and safely. This week is all about notes, which is near and dear to my heart as a note investor. I love talking to experienced investors, learning from them, and seeing what types of note nuggets I can get from my interactions with them. And this week, our guest is providing 40 years of experience and talking about all things notes. So without further ado, let's learn about our guest before we dive right into the episode. Eddie Speed knows how to architect a deal like the back of his hand. For almost 40 years, he has purchased more than 40,000 notes, and the Note School executive team has bought $3.5 billion in notes. As an esteemed teacher of all aspects of real estate notes, Eddie's innovative methods have earned him multiple industry awards and inaugural induction into the Small Balance Real Estate Hall of Fame. He has spoken at events across the country, teaching people how to find freedom and flexibility through a widely untapped and extremely profitable area of real estate investment, creatively buying and selling notes. At his core, Eddie is a problem solver. He is skilled at identifying roadblocks most investors couldn't work around, and in finding solutions to creatively close in a way that's exponentially profitable. In 2003, he founded Note School, a real estate coaching program that teaches students to buy and sell performing and non-performing notes, as well as other alternative purchasing strategies like seller financing. Over the past decade, he has helped countless investors expand their portfolios by millions using his out-of-the-box techniques. Now that you've learned about our guest, and before we dive into this week's episode, don't forget to leave the Tech Guys Who Invest podcast a review on Apple Podcasts so that we can reach like-minded people like you listening to today's episode. And don't forget to subscribe to stay up to date with the podcast, any industry information, any investment updates, anything like that to be a part of the Tech Guys Who Invest Insider community. All you have to do is go to tgwipodcast.com/subscribe, enter your email, and be a part of the TGWI Insiders group. Welcome, everybody, to another episode of the Tech Guys Who Invest podcast, where each week we teach you how to invest wisely and safely. Today, we're bringing on Eddie Speed to talk everything notes. Welcome, Eddie.
How are you?
Great. Thanks so much for coming on the show. We're really glad to have you. So I'd like to kick it off with a question that's pretty relevant to something we're all going through at the time of this recording anyway, and that's COVID-19. Can you talk to us a little bit about how that's impacted the note investing space?
Well, there have been some aspects of the business that have been dented in fairly hard. And then there's been other aspects that really haven't been that bad. So I generally tell people that our loan portfolio overall has not experienced that much slippage. Not anything to the degree of rent, but yes, some people have been affected. And I think loan servicers, and their effectiveness and how they've dealt with it have gotten a lot better as it's progressed.
Gotcha.
Okay. And when you said it's not been affected as much as, say, rent, what would you attribute that to, if there is anything that you could attribute it to?
That's a good question. I just, the rental market has really been clobbered, particularly the small landlord. I mean, his lack of rent is about double of professional landlords. So that market it's become pretty critical. The loans that we bought, and I realized somebody could have lost their job in the virus and they could have paid for the loan for 10 years. But a lot of the loans we buy, I think they're a grade up from the typical seller finance note people think about. And we just, we haven't had that much slippage. My wife and I were talking about it at our retirement account. I knew had this interview. And my wife and I were talking about her portfolio that she manages for us, where she just buys strictly for, tax advantage accounts. And she's got a couple of people that are now delinquent, but they're current, and she didn't have anything that she sent a notice of default on. That's pretty good.
Yeah,
I mean, that doesn't represent all the loans we have under management, but it's a pretty good representation.
Well, that's good to hear. That I'm happy that you aren't experiencing that much trouble within your portfolio. Now, in 2008, when the market crashed, the Great Recession, at the center of it was mortgages and note investing and stuff like that.
Mm-hmm.
From my understanding, Dodd-Frank came of that to kind of help prevent something like that from happening. Are you seeing any lasting changes happening from COVID-19, similar to that with the Dodd-Frank and the Great Recession?
Well, there's a giant behind the curtain. There is no doubt about it. There are people love to talk about forbearance.
Right.
So there's about 3.2 million loans in forbearance, but there is 3.9 million loans that are delinquent and not in forbearance. You add those two up, you got an issue.
Yep.
And so that's about 7 million loans. But according to the U.S. Census Bureau, 17 million households did not make a rent payment or a mortgage payment.
Wow. In
January. And, I don't know what you think's a giant number, but that's a giant number, so, and I alluded to that when we talked a minute ago. I mean, the rental factor and small landlords and stuff like that. So, it's the wildest market I've ever seen. I've been doing this 40 years, right? I've never seen a market so good as it is right now. Yet there's so many things that are kind of behind the curtain. And when are they going to merge? There's a shortage of listings. Houses are appreciating, at a 15-year high, right? 34% less listings than there were a year ago. So that's problems if supply and demand, right? But on the other hand, there's a lot of problems lurking. So I find that the smart investor is the informed investor. And, I just think we all got to be aware of it helps us determine it, because that's the name of your show, right? Guys who invest.
Right.
And I mean, what are you investing in and what's the case? I'll tell you this. I regularly train super high volume house buyers. I have had at least 200 of them come to a note school class in the last couple of years. I mean, guys that are 75 house a year plus guys. How about that? And generally speaking, to be perfectly honest with you, they very seldom ever know the stats that I've just given you. And yet I hear a lot of them say, man, I'm building my rental portfolio like crazy. And I'm like, oh my gosh, I'm not sure that's very smart. And, but it's funny when I give them this data, then they're like, oh, well, I didn't know that. Well, wait a minute. And that's what your podcast is about, right? How do you become an informed investor?
Right.
Yeah.
Yeah. It's kind of scary. I'm scared for people like that, people who don't do their homework. And you're absolutely right, Eddie. Kevin and I do this show and talk a lot on the show about doing your part to educate yourself and make sure you understand what you're investing in. I mean, it's one of the reasons we don't like the stock market, because we feel like there's so many hidden places there that are tough to find out the things you would want to know as an investor. So,
well, Adam, I can go on Facebook and ask a lot of people that I have no idea of their competency or their resume, their hot sports opinion, and they'll gladly give it to me.
That's
where I get all my expert advice.
Well, I'm telling you, I just eliminate that from my life. People will tell me stuff that's posted on these special Facebook groups, and I know you're on there with some of our guys, but I just stay out of it because I can't deal with it.
Yeah.
Why would you ask
No,
somebody
I
that
hear you.
opinion when you don't have any idea if that's competent advice?
Yeah. It's scary that someone would act on it.
Yeah.
So continuing on with this kind of direction, we're taking this conversation. How's the note investing industry changed, or maybe where do you see it going? Might also be the question there.
Well, if you look at what has driven what we call the private note business, right? The private note industry, or buying notes that somebody else has created, is 100% driven by where's the void in the market. If conventional lending fixed every problem, we wouldn't exist, right? I mean, we are always filling the void that conventional lending doesn't fill. So I got started in 1980. What was the deal? High interest rates, right?
Yeah.
Excessively high interest rates. And excessively high interest rates said that conventional mortgages, traditional financing, wasn't an affordable payment. They forced the rate payment so high it wasn't affordable. Okay. Well, if that's true, and it certainly was, go look at every cycle in our industry and see exactly what happened, which was this industry filled the void conventional lending doesn't fill. So the bigger news, by the way, I never see anybody talking about this other than in the deep industry rags, DS News, Housing Wire, they write about this almost every week, but nobody else ever does it. You certainly don't hear it on the nightly news. And that is, somebody failed to tell the general public that in the last 12 months, that mortgage banking credit availability has dropped 35%.
Yeah, you don't hear that on the popular news.
Well, I don't know whether it's intentional or accidental or whatever the heck it is, but it's the truth. Is that void good for our business? 100%. You just told me that there is this gigantic pool of people that need seller financing, creative financing, because the conventional mortgage industry has said, we can't make you a loan. That's me. That's what I've done for 40 years, is figure out where there's a void and figure out how to go structure a scenario within that void that I'm filling a gap for somebody. And all of a sudden, that's what entrepreneurs do. They solve problems.
Love it. So, Kevin's smiling on the inside right now.
I am. I agree. This is there's a problem. We have a solution. And speaking of that problem, for those who are unfamiliar with seller financing, who would be the typical types of borrowers in a seller finance transaction?
Well, let's don't talk about unsophisticated seller financing, because I don't feel like that they're not making the best decisions. Some people seller finance to get rid of their property. Fair. I seller finance to gain a customer for my bank. So instead of seller financing going, well, I had to seller finance because the story of the buyer or the story of the property or whatever, that's not the best reason to seller finance. Right. What I love to say is, I was able to give somebody ability to own a property that otherwise they wouldn't have had because conventional lending left behind. And what I love about it is they are good customers. They're qualified. They have a high propensity to pay. And now I've got somebody that's going to pay me for a long time in the future. That's a great reason to be in the business.
Yeah, it really is. Eddie, I think our listeners would be really curious to know how you feel comfortable qualifying those types of people that don't qualify for it from those institutions that most people know about. Can you talk to us a little bit about how you do that? Like, how you mitigate the risk and yeah.
Mortgage banking has left the front door open, right? The average conventional mortgage today is about a 768 credit score. The average conventional mortgage down payment is 19% down. I mean, if you're self-employed, you almost have an X on your head. I'll tell you a personal story. I have good credit. My wife has good credit. We own an exec home that's an executive home in a ranchette community. So I kind of out a little bit on a small amount of acreage. We owe about 35% of what the house is worth. We have excellent credit, and we went to refi when everybody else went to refi. And the guy called and stuttered and stammered and stuff and goes, underwriters, we own 8 companies. They could they flipped their gourd. We couldn't get a refi.
Oh my gosh. It's just unbelievably ironic that a guy who loans, makes notes, sells mortgages, trades mortgages for a living, couldn't get the refi from the bank. It's crazy.
Talk about irony. I agree.
I know.
And I share that story really to say that I am a victim of what the market is, which is the traditional mortgage market is heavily moving away from financing anybody other than a W-2 employee. They certainly didn't turn us down because of credit.
Right.
They didn't turn us down because bad pay history. They didn't turn us down because we didn't make enough money. They turned us around because they couldn't put a box around us.
So I hear that, and it sounds to me like there's potentially going to be a greater need for seller financing. And I remember early on during the pandemic, was it Chase or one of the big companies said, we're tightening our lending restrictions. You need to have over a 700 credit score. They will take no less than 20% down. I see that and I think, okay, there are a lot of people that don't fit that category that would still be great borrowers. I see it as seller financing is going to be a huge push. I'm asking you to break out your crystal ball now. And if you're okay with that, what do you think? Is there going to be an increase in seller financing? Does it stay the same? What are your thoughts on the market moving forward?
Well, once again, if I look back over my life in the business, if I'm trying to judge how busy I'm going to be chasing seller finance notes, I've got to measure what the competition is for lending. And the competition very simply is seller finance. Nobody's going to seller finance if conventional lending is solving every problem. And the more they tighten their credit criteria, the more they're pushing people off of the conveyor belt onto they need a problem solve. And that's exactly what we see our market doing and how we see it working. So here's the deal. Today, there is about 100,000 seller finance notes generated annually. Wow. And that's been true since about 2015. So about 100,000 a year. Now, by the way, a very small percentage of those notes ever get bought in the secondary market, right? Which tells you that if the note flipping business is overcrowded, if the house flipping business is overcrowded, and trust me, it is, the note flipping business is seriously undercrowded, right? Will tell you that, I would love to really get, somebody that is willing to go do some work and be a hustler, and not in a bad way, but go get after it. There's a big opportunity for somebody to go do it. So that's where we are now. Where do I see us in 18 months? Crystal ball. I think that we could easily see 200 to 250,000 owner finance notes generated every year.
More inventory for me to buy. I'll tell you that much.
I mean, and I could go back and give you historical, reasons that I say that. It's just simply when you see that void, you just know that void's there's gonna be a gap.
Yeah, absolutely.
Awesome. Well, another question when we're talking about seller finance notes, compared to institutional notes, how would your due diligence differ between a seller finance note or something that was originated from, I don't know, Wells Fargo or something?
Well, the only chance that somebody like us is going to get to have a look at an institutional note is somehow the bank has written the loan off on the books. It's had to have had a problem.
Right.
Right. I mean, they don't go originate a loan and then turn around and sell the note at a discount, right? Unless there's been an issue. So the one thing about a seller finance note is that we're going to see loans that have good credit, good down, good scenario that they've just seller financed because they're filling that gap. And once again, the reason we talk about pay history of a loan, like people put a lot of emphasis on, well, a seller finance note has a pay history. And by the way, we have a note trade platform called Notes Direct. The average seasoning on Notes Direct is over 6 years.
Wow.
And that's been true for probably the last 1,000 assets we pushed over there. So we have chased some loans with really good long pay histories. Now, let me say this. They did not have the degree of underwriting up front that I would have liked to have seen. So why did we buy them, or why did we allow them to go on Notes Direct? The pay history was a redeeming factor, right? If you have a guy with an 800 credit score and 15% down, do you really need to see 6 payments made or 12 payments made before you're willing to buy the deal? No, probably not. So the idea is, I always describe it as just a scale, right? There's not one thing that makes a note good. There's a combination of things that say this has enough redeeming factors, or just there's enough negative and not enough redeeming factors. I can't get to a buy decision on that asset today. Does that make sense?
It does.
Very much
It makes
so.
a lot of sense. And where could someone who's not an experienced note investor like you or Kevin find how to know what those things are? Like, how to understand what those things make a good buy decision?
Well, you could go to note school.
Nice. I like it. Note school.
I wasn't trying to put the plan on it. I'm just
perfect.
saying I realize that. And we are teaching people an art of underwriting, because if you're going to stick solely to the science of underwriting, you're going to say, well, here's my matrix and I buy everything inside this matrix. And I'm just going to tell you something. You're going to leave too much business left behind if you do that. So that scale, that redeeming factors, and all the people I've ever taught to do this, which is a lot now, that was the sticky thing that they could learn from.
Nice. And we'll put that in the show notes, the URL for Eddie's note school. So following up on that, Eddie, there are people out there like me who invest in other things primarily. So I'm a large multifamily guy, but I like having a diversified portfolio. So I wouldn't mind having some notes in my portfolio. How could someone like me do that without jumping in and becoming the full-time note investor?
90% of the people that we coach and train are far from full-time. So that most people that we train do something else. In fact, I'll tell you a funny story, but it's absolutely the truth. If I picked a town in the United States that I've trained more people than any other town in the United States, you know what the name of that town would be?
It's not Tampa, is it?
San Jose, California.
Interesting.
Absolute truth.
Never would have guessed that.
Yeah.
Never would
Because
have
once
guessed that.
again, they have high income, and I mean, let's just be fair about it. It's a heck of a lot easier to own a note than it is a rental property.
Very much so.
Yeah, that's true.
Yeah.
No
And
maintenance.
Adam, this is up for debate, but it's going to be a good time to kind of adjust your thought process on multifamily.
Yeah, we've shifted it. We've shifted more towards the B plus. And,
well, I'm just saying the industry has had quite a dent in its income. I don't think it's had quite the dent in its expenses. So the NOIs on these assets are down, and that's how they're valued. So
Right.
There's going to be a lot of projects that people's could not replicate what they bought it for 2 or 3 years ago. In other words, let's just be fair about it. If you went and put a bunch of multifamily on the market right now, you wouldn't be thrilled at seeing the values. I'm not saying the good thing about rentals are you can rent your way out of it, right? So if you were looking at investing in a rental today or a multifamily today, then you probably have fairly accurate numbers. But I'm saying I do believe we're going to see a reset in values. Not in every project, nothing like that. I'm not saying that, but I'm saying to you that you're looking at an industry that has collected about 20% less rent in 2020 than they did in 2019. That's a strong number.
So there's so many factors to consider with location and all of that as well.
Fully acknowledged.
Yeah.
You can't paint them all the same way. Yeah.
Now, what I'm hearing there, Eddie, when you talk about that is multifamily notes, commercial notes, because some people may have had rose-colored glasses when they did the underwriting for this multifamily property. Turns out they may not. That being said, where could somebody, I guess this is a selfish question, where could I go and find a multifamily note, something along those lines?
So it's funny. I spent a Saturday out just having fun, but talking business with a guy, and he's got about 100 million under management, multifamily. And he asked me the same question. And I said, well, you have to understand that lenders that sell problematic loans at deep discounts sell them fully understanding that they are not triggering some loss that they can't take. Meaning that most of the time when you're looking at loans that are being sold at deep discounts, they've already charged them down what they have on the book. So just because they owe $1 million doesn't mean that their remaining book value is $1 million. The book value, they may have already accelerated a loss, and they may be down at whatever, 300 grand. So the deal is you don't go just chase every delinquent note. You chase delinquent notes that accounting wise that they can afford to sell it for what you'd want to pay for the note. So if you're specifically doing that, I would drill in on the servicers, right? The banks are not fixing to go turn loose of a bunch of commercial assets at deep discounts at the moment because they've had a reprieve in their accounting.
Okay.
So understand, I'll tell you some loans that I definitely can see that are going to fruition and are going to be REOs is CMBS loans.
And what are CMBS loans?
Commercial mortgage-backed securities. And that's an asset class I definitely can see that happening in. There's a lot of GSE loans, government sponsored enterprises, right? There's a lot of GSE loans in like the multifamily space, like Fannie loans.
Right.
Those loans have got to get charged down before they're going to sell them at a deep discount. In other words, everybody tries to be really logical and look at when the lender sells a loan, well, the property's deteriorating, so they better get rid of that loan or it's just going to get worse. It has nothing to do with it. It's all accounting.
So, Eddie, for our listeners who may not know what charge down is, could you explain how that process works or further define it for us?
Yeah. So loan loss, right? In other words, a lender bakes into their books a loan loss, and it's typically called a loan loss reserve. And so it's just an accounting process where they say, we think we've got X amount of loans that could become problematic. And so we're going to build up a reserve for that. And so if we see loans that have, some injury, then all of a sudden we're going to start applying that loan loss reserve to them. And typically that's done on a monthly basis or a quarterly basis. So just think in terms of, if a lender is having problems, they started charging a loan down. But see, a lot of times in this forbearance process, they haven't charged the loans down yet because the government came in and said, look, we're just going to freeze everything. We're going to freeze the borrower. We're going to freeze the bank from having to take a hit on their books yet. We're just going to give everybody a check in place. Let me tell you, though, there is an issue with loan servicers that a lot of people are unaware of, and this is where there could be some significant opportunity. Okay. So after 2008, loan promoters that were loan servicers that were putting gigantic loan deals together and selling them on Wall Street, mortgage-backed securities, right? One of the things that they agreed to in order to make their market whole again and to make it work again is they essentially said, look, if you're not collecting your payment, Mr. Bondholder, we're going to make your payment for you. For the borrower's not making the payment, we're just going to make the payment. Not only are we going to make the payment, but we're going to also pay his taxes and insurance. Now, I know this sounds crazy, but let me just tell you, Mortgage Bankers Association produced a chart last month that said $3.2 billion of people servicing residential loans, the servicers made a payment to their bondholders they didn't collect. Oh, and worse, add another 1.3 for taxes and insurance. How much money is that? Well, that's totaling $4.5 billion a month. Now, I don't know how long they can write that check, but that's absolutely a fact.
Wow.
So we've got meters all over this thing. We're trying to monitor from every side and everything that we've seen. But I will tell you this, that if you're looking for when's the bonanza of defaulted loans and what is it going to be? Is it going to be commercial? Is it going to be residential? Let me tell you where I see the dropping knife. Okay. The dropping knife that I see is the knife is headed towards commercial, but the dropping knife is pretty high. We're pretty quick in the cycle to say it's time to go chase that. I'm not saying there's not a bargain. I'm just saying I don't think it's run its course long enough for me to have. I would be pretty nervous to go deploy a lot of capital at the moment in that asset class because I just think it's going to get cheaper. Think in terms of when did you buy the best bargain? Early 2009 or late in 2010?
I'm guessing 2010.
Correct. In other words, it's a falling knife market, right? That's
Gotcha.
The expression. Well, the knife just hadn't fallen that far yet. On the resi side, it's going to happen. It's going to happen. For one thing, I don't believe loan servicers can handle 7,000 loans on the resi side. Now, people say, in forbearance, they're all just going to get modified and it's all going to be good. isn't it true in Dodd-Frank you have to qualify to modify a mortgage? Oh
Yeah.
yeah. Oh yeah.
So if the forbearance period is up and you try to qualify, but that source of income is now cut in half, or they no longer can do it, what are you supposed to do?
The mortgage banking industry doesn't have any confidence that these forbearances are all going to end up mods. I mean, there is naturally going to be some of that, but I can just tell you that mortgage banking industry just doesn't see it that way.
Eddie, what can people do right now to prepare for that? Someone hearing this may think, hey, I want to be ready when that happens. What should I do now to prepare for it?
Well, there are a lot of, like, I tell people that come through a training cycle with us, there are things that I can be really aggressive at right now. And I go through a waterfall of things that I think that is. I think really somebody with private capital can help more, help real estate investors. I think there's some definitely joint venture opportunities that can happen with that. And you wouldn't be buying a property at an inordinate level of risk in the way you structure the deal, right? So I'm not tapping the brakes right now. I'm just not foolishly driving 90 miles an hour, when I know the bridge is out up there, right? I'm trying to strategically look at where I see the opportunities. And I do see that there's terrific opportunities because mortgage banking has fell off. Everybody is really fired up about the NPL space. We just haven't hit that cycle yet.
And what's NPO for those who may not know?
NPL, non-performing loans.
Okay.
Great question. Thank you.
All right. So Eddie, it sounds like we're talking about a lot of, what is the word? The phrase, gloom and doom. But I think notes, and this is biased, but notes are a fantastic asset that every investor should have in their portfolio. Somebody listens to this, they're on the fence about it. What would you say for them to almost convince them that they should have notes as part of their portfolio?
I think it's a hell of a lot better window in the next 5 years to own a note than a rental property.
Interesting.
That's exactly how I see it.
Okay. And one objection I've heard from people is that note investing is kind of too long of a play, a long-term play for your money. And of course, I'm more of a buy and hold person anyway, but how would you handle that objection if someone says, I think notes are too long, my money's out for too long?
Well, what's the prepay speeds, right? In other words, it's not how long the loan is amortized. It's what triggering event caused the loan to pay off early. Typical prepay speeds on seller finance notes about 7 or 8 years. I don't care if it's a 30-year loan. I have I care nothing the difference between buying a 15-year loan and a 30-year loan. I promise you it has nothing to do with when you're actually going to get paid back. So these loans historically, statistically pay off early. So if somebody says, I don't want to make a 30-year play, well, I don't either. But you're going to wake up and be sad a loan pays off, not be happy it pays off, but it will pay off.
Fantastic.
So Eddie, can you tell us a little bit about Note School?
So about half of Note School are real estate investors, right? They're in Note School to learn creative financing techniques. And I show them creative financing techniques really, and probably 70% of those techniques take some private capital. So then I show the other side of the market, which are guys that want to invest in notes or be the bank side of the business and not the working side of the business. I show them how to work together. I show them techniques and leveraging techniques and a lot of different ways that you can configure how a deal is financially structured, the capital stacks, what a Wall Street guy would call it. I show them how to do that. And so my audience is half people, as you said, they're tech guys or they're retirees or they're whatever. And the other half are like, active house buyers. Now, they don't all buy 200 houses a year. Some of them, buy 10 houses a year, but some of them do buy 200 houses a year. And I've just melted together that, once they have a common understanding, then it's not hard for them to have a common bond. And that's why I say it's not a time to tap the brakes. The average loan that a real estate investor does with a really a passive investor, he's at about 50% of the value of the property. He's not, that's way different than going and buying a rental and being 100% in the deal. Does that make sense?
Yeah,
So
very much so.
There's a lot of opportunities. There's various ways an investor can have a very modest risk profile into a deal.
Nice.
Yeah.
Okay. Well, Eddie, we wouldn't be the tech guys who invest if we didn't ask you a tech question. So we want to know, as far as tech goes, what would be a piece of technology that the note investing market is in dire need of?
A processing system. I mean, there is no processing system really out there for buying discounted seller finance notes. There's people, Podio is a common name that you hear, and people will build on a Podio platform and this and that. But we use a system that was built by a company that did about 350 seller finance notes. They bought delinquent notes and seller finance the properties and stuff. But it's not a good working system for a small guy, right? Our staff is, really worked at it and stuff. And there's a few bigger operators in the business that use that platform, but they didn't build it for the little guy. So I would say that really a processing system is really something that's desperately needed.
Fantastic.
Nice. Well, thanks for not saying Zoom or Eddie, it's been great having you on. Thanks so much for all of the wisdom and knowledge you've shared. If folks want to get a hold of you, what's the best way to do that?
Well, we've got a link for you guys, which is noteschool.com/grow wealth. And we'll have a little workshop, and we'll have a white paper and stuff. And it will be best if they could get a sense of how they could do it. And this will give them a very good sense of a real deal, real stuff. And they can see like, oh, I can see that. I can see myself doing that. And obviously we'd love for them to progress and decide to come hang out with us at a class. And those classes are kind of a hybrid. Some of them are kind of work before you get to the class, and some of them are at the class. Now, right now they're virtual. We've done over 20 virtual 3-day classes. So we've gotten pretty good at it, but we still, we want to engage with them. We don't want them just sitting back, kind of treating it like a movie,
Right. Yeah, hopefully soon.
Yeah, hopefully soon. Well, you know what, Eddie, thank you so much for your time today. We'll put everything that you mentioned in the show notes. There's so many nuggets. We could probably talk for hours, but we want to be respectful of your time. So thank you so much.
Thank you. It's great to be here.
Thank you so much for listening to this week's episode. Be sure to subscribe to the podcast for the latest episode updates and to receive investor insights to help you invest wisely and safely. You can join the TGWI Insiders community at tgwipodcast.com/subscribe. Don't forget to leave us a review on Apple Podcasts. The feedback helps us grow and helps us give you the best investing content out there. For a step-by-step guide on how to leave a review, head over to tgwipodcast.com/review. And lastly, we'd love to connect with you. The best way to reach us is by sending us an email at techguyswhoinvest@gmail.com.